Hello and welcome back to the 23rd episode of The Market Lens. I'm Sam Rozzi, and again, I'm joined by Cliff Walsh, American Portfolio's Chief Investment Officer. If you need to catch up on past episodes, you can do so in the Studio 454 video library or on YouTube. Welcome to summertime. The weather is certainly heating up, and so are the markets. So we're going to skip our normal news or noise segment and dive deeper on interest rates. Cliff, I want to go into your financial market outlook, being that we just closed the second quarter, which happened to be the worst half of S&P 500 performance since 1970. Let's zoom in on interest rates. Fed interest rate expectations have shifted as recent economic data has come in softer than expected, and commodity prices have begun to roll over. Can you update us on the market's current positioning on rates?
Sure. Market expectations have definitely shifted. I'd say more so for 2023 at this point. Expectations for the back half of 2022 are still pretty stiff. I think that they are still overly aggressive, but they are very stiff at this point and haven't shifted that much. So for the upcoming July meeting, the market is looking for 75 basis points. I think we'll get 50 or 75, leaning towards 75. 50 in September is the current expectation, and another 25 basis points in both November and potentially December. Right now, December is 50-50 on 25 basis points. So as you said, pretty stiff.
Wow, yeah, so that means the market is pricing in a Fed funds rate of 325 to 350 basis points by the end of 2022. What about the expectations for 2023?
For 2023, I think the first meeting of the year in February shows some stabilization. The market appears to expect rates to peak by year-end this year. And as we look out to each successive meeting in March, May, June of 2023, futures market is looking for mild easing. There's no strong consensus as to which meeting it's going to occur on, but on average, let's say 25 basis points in each of March and July in terms of rate easing. So yes, expectations have shifted. The significance is not so much in the rates the market is expecting, but I think the timing of the peak, which has moved closer by about 6 months. So we're looking at a peak at the end of this year and not mid-year in 2023. And this is a big change only from a month ago.
Yeah, so if you would have told me a year ago that rates would be where they are right now, I would have said you're crazy. So what are your thoughts on the rate hike cycle at this point?
As I mentioned, I think expectations are still too aggressive. I see the peak being September of this year, but if I'm wrong, it's more likely to be earlier, potentially in July than November. That's my current view at this point, just based on the economy that we're seeing right now. Data is starting to weaken, and I think the Fed has been too aggressive to this point.
Yeah, no, I agree, but it's probably shocking to a lot of people out there that the Fed would do that much of a pivot in policy. So how do they actually accomplish this?
I don't know how they accomplish it. I think they are going to see economic data that's weakening. I think the weakness is gaining steam. It's spreading well beyond housing, which has seen mortgage rates peak at 6%. Retailers are talking about customers trading down on food, buying fewer gallons of gasoline at the pump. The Atlanta Fed went from predicting Q2 GDP growth of 2.5% to now it's negative more than 1%. Commodity prices have begun to roll over. We're seeing declines of 15 to 25%. In metals, oil, even agriculture, despite the significant export reductions out of the Ukraine and Russia. Even industries like semiconductors that were the most impacted by the pandemic, you're seeing demand destruction there. That's despite tens of thousands, if not hundreds of thousands of cars sitting on the sidelines waiting for chips. So those companies are talking about seeing demand destruction. The consumer sees a recession. Current prices are causing them to pull back, and as you know, 70% of the economy is consumer driven. Without Russia invading Ukraine, I thought the hike cycle was going to be over sooner. I think the Fed just sees the economic data coming in a lot weaker, seeing earnings expectations coming down in July and October, and sees the inflation data easing sooner than expected, and then they pull back.
Yeah, interesting, honestly a bit scary. So what do these predictions mean for financial markets moving forward?
Well, we've seen 20 to 30% declines in equity prices. So the froth has come out of, the equity market. Certainly some industries are seeing recession factored into their valuations. But I do think that more downside, broadly speaking, is expected. Certain stocks could, obviously have more than, bottomed and starting to see some turnarounds, but on a wide range, I think we see more of a decline. Valuations are reasonable at this point. We've seen come back down to historical valuations. Certainly, we could have bear market valuations, see a couple more turns in valuation come out of the market, but I think it's more likely that earnings expectations see the next big downswing, and that's going to happen in the July and October earnings estimates. Probably more October than July, because companies that give annual guidance are probably going to see more so in October be less reasonable and less likely to hit than in July. But we'll start to see it this quarter coming up in this next week or so. And I think I'm hoping for the midterm elections to show some gridlock and be a catalyst into next year. So hopefully we see equity prices bottom, in September or early part of the fourth quarter. The midterm elections, are a catalyst into, Santa Claus rally.
Yep. Thanks for your expectations on equity markets. Let's switch over to Treasuries and the U.S. yield curve. We've seen a huge bounce. What do you think is going to happen moving forward?
Treasury have begun acting like the risk-off asset they've been historically. More so than they have been, over this last year or so. I think with inflation having peaked, and that's our view, but I think you're going to likely see that in the data. We'll see long duration work nicely. I think that could potentially fuel growth equities over value, especially as cyclicals still see earnings downside. I don't think we're there on high yield just yet. I still think we're going to see some risk off, but my forecast is long duration now. High yield may be seeing opportunities later this summer or early into the fall, and equities being last, perhaps September or October, seeing their bottom and rallying into year end. From what prices, we don't really know, but I think it's going to be down double digits at least until we start to see things rotate and turn around.
Yep. Thank you, Cliff. We'll keep close tabs on these talking points moving into the end of the year. We hope this is letting you see 2020. Take care.